You know, deep inside our modern financial markets, there's this powerful, almost invisible force at play. It's called high-frequency trading. And today, we're going to crack open that black box and see what's really going on inside.
All right, so to really get a handle on where we are now, we first have to look back at where we came from. I mean, picture the old Wall Street, right? A chaotic pit, traders yelling, paper flying everywhere. Now contrast that with today's Wall Street, a dead quiet, climate-controlled room filled with servers. The human drama? It's been replaced by the steady, silent pulse of the machine.
Which of course brings up a pretty fascinating question. If the trading floors are empty, who's actually making the trades? Well, the answer isn't a who, it's a what. And it operates from inside a mysterious black box. Well, it turns out the new architects of the market, they're algorithms. We're talking about complex sets of computer rules that can execute millions of orders in literally the blink of an eye.
And that is what we call high-frequency trading, or HFT for short. You can pretty much think of it as automated trading, but on a whole other level, like on steroids. These algorithms are built to spot and react to the tiniest market movements in microseconds, a speed that is completely beyond human perception.
So, okay, how do these super-fast algorithms actually work? Well, they operate right inside the digital heart of the market, something called the limit order book. Now, it might sound complicated, but the basic idea is actually pretty simple. You've got buyers, right? They post bids. That's the price they're willing to pay. Then you have sellers posting asks, the price they're willing to sell for. HFT firms jump right into the middle of this. They act as market makers, placing both bids and asks at the same time. This creates this incredibly intense, high-speed competition that forces the gap between the two, what we call the spread, to become razor thin.
And that is the big promise of HFT, you see. When that spread gets smaller, it means trading costs go down for literally everyone. So whether you're just a small-time investor or a giant pension fund, it becomes cheaper to trade. On paper, it's a total win-win.
But, and you knew there was a but coming, right? Here's the twist. This incredibly efficient system, it has a hidden and potentially catastrophic flaw. It's something called the phantom liquidity paradox.
Okay, so the theory goes like this. All these millions and millions of orders flying around should create a really deep, stable market. There should always be buyers and sellers available. We call this liquidity, and it's basically the lifeblood of any healthy market.
But what researchers started to figure out was that this liquidity, well, it could be a dangerous illusion. It looks solid, but when you poke it, it can just vanish into thin air. It becomes phantom liquidity. So what exactly is phantom liquidity? Imagine this. It's all the market depth that seems to be there when things are calm and quiet. But the second the market gets stressed out, the very moment you actually need that liquidity to sell something big, poof, it's gone. It's like a mirage in the desert. And how this happens is, well, it's kind of wild. These HFT algorithms use what are called flickering quotes. These are orders that get placed and then canceled in microseconds. I mean, way faster than any human could ever hope to trade against them. So it gives you the appearance of a super busy market, but there's just no real substance behind a lot of it.
And as you might guess, this wasn't just a theoretical risk for very long. On one crazy afternoon back in 2010, the phantom became terrifyingly real.
It was May 6, 2010. A single, pretty large sell order hits the market, and it starts this massive chain reaction. By 2:42 p.m., the HFT algorithms, their risk management protocols kick in. They see the drop and they start selling like crazy to protect themselves. But then, by 2:45, almost all those HFT orders just vanish. They're gone. And that creates a liquidity vacuum. Suddenly there are no buyers left and prices just fall off a cliff. In just a handful of minutes, the whole market is in a nosedive. $1 trillion. That's the amount of value that was temporarily just erased from U.S. markets. And it happened in minutes. It was this shocking demonstration of just how fragile this new machine-driven system could be.
Now, it's really, really important to understand this. HFT didn't start the fire, okay? A human-initiated order did that. But HFT was like pouring gasoline all over it. It acted as a massive accelerator, turning a pretty big drop into a historic, terrifying collapse.
Yeah, so the flash crash was a huge wake-up call for everyone. The thinking became, okay, if the market is going to be automated, then our safety nets have to be automated too. And this kicked off a whole new era of regulation.
So regulators started building this new toolkit, basically installing digital speed bumps on the information superhighway.
You've got circuit breakers, which were updated to automatically pause the entire market if things drop too fast, just to give everyone a chance to breathe. Then there's limit up, limit down rules, which are a bit more like a scalpel, stopping a single stock from spiraling out of control. And people are even proposing things like minimum resting times to go after those phantom, flickering quotes we talked about, basically forcing orders to stay on the books for a bit longer.
And all of this, it's part of this new philosophy called computational governance. It's this really crucial idea that you can't regulate a 21st century market with 20th century tools. It's about building safety right into the market's code so that law and technology can actually evolve together.
But of course, these new guardrails haven't completely solved the problem. Not by a long shot. The fundamental mystery of the black box is still there, and what we have now is basically an ongoing code war.
And the challenges are, well, they're huge. First off, the algorithms themselves are still top-secret proprietary code, so the black box is still very much locked. Then you have firms still getting a huge speed advantage just by paying millions to physically put their servers right next to the exchange's servers. And on top of all that, regulators are just drowning in a tidal wave of data, trying to find the important signals in all that noise.
Which leaves us with this one final, really big question. In a market that moves faster than we can even think, who's actually accountable when the code goes wrong? Is it the programmer? The trading firm? Or is it the machine itself? Honestly, that's the question that regulators and all of us are still trying